right around 51.60 or so, climbing back up. The strength that it is exhibiting in the face of continued attacks on it, and a huge backwardation, something I've never seen before, as much as a $3 spread between the spot market, the OTC market, and the December futures contract. This shows a massive stress in the system. Unprecedented strain, to your point. It is unprecedented. And it's not just volatility, Michelle. It's kind of, to me, it's the market exposing the shortage of physical silver and the fragility of the paper promises. I think this is something that is far more than just a one-off. It's something I've never seen before.
The silver market has shown consistent, unusually large flows of physical metal into trading centers, persistent strength in spot pricing despite paper market pressure, and an elevated premium between spot and futures that is rare outside of crises in recent months. Famous bullion dealer Andy Schectman claims these are neither market blips or arbitrage maneuvers. Instead, these are signals, possibly planned efforts by well-resourced individuals, that suggest a more strategic perspective of silver's function than mainstream criticism has permitted. The investor should remember this. When large players approach a commodity as a strategic asset, price dynamics follow liquidity, not narrative. Andy's main point is simple but controversial. He claims that well-funded buyers, including U.S. agencies and sophisticated Wall Street players, have been investing large sums in physical silver purchases, often through exchange mechanisms, to secure real metal rather than paper claims. If this is happening at his magnitude, it has major consequences. The move from paper reliance to physical accumulation changes the risk calculus for bullion and derivative exposure holders and challenges some of the assumptions about contract fungibility across multinational vaults. Note that this is not speculation without market stress. Market symptoms are evident. Sharp spot volatility in brief windows, frequent and aggressive attempts to control price surges, extreme variability between location markets, and delivery behavior that appears like metal instead of rolling contracts forward. The thesis is based on those facts, which experienced participants detect. We will explain market mechanics and the logical relationships between delivery strain, counterparty behavior, and price signals for investors who want proof. Andy discusses the fragile float in London vaults, the abnormal backwardation indicating urgent demand for immediate delivery, the government's reclassification of silver as a critical mineral, and major state and sovereign actors' coordinated accumulation in his latest interview. Like the video, subscribe to the channel, and switch on notifications for more data-driven insights. Please enjoy the video, and thanks for supporting us.
And just like that, by Tuesday or Monday night, last night, it was at $53.30 spot price. Now that would have been in Asia trading. And now they've knocked it down again today, trying to mitigate its rise. And today, right now, we are, where are we? We're right around 51.60 or so, climbing back up. The strength that it is exhibiting in the face of continued attacks on it, and a huge backwardation, something I've never seen before, as much as a $3 spread between the spot market, the OTC market, and the December futures contract. This shows a massive stress in the system. Unprecedented strain, to your point. It is unprecedented. And it's not just volatility, Michelle. It's kind of, to me, it's the market exposing the shortage of physical silver and the fragility of the paper promises. I think this is something that is far more than just a one-off. It's something I've never seen before. Very strange. You and I have talked at length. Since November, we've seen a continual influx of metal coming into the COMEX market. And you can blame it on tariffs or blame it on arbitrage or blame it on whatever you want. I don't believe any of that. I think this is much deeper. There are people that want us to believe it's not as deep. Even the Bloomberg article that says that there are ships that are being loaded up to send silver over to to London. I don't believe
Don't
that at all. As a matter of fact, I think that's spin doctoring, kind of to buy some time for the LBMA. If silver was so plentiful, they wouldn't need a PR scheme to tell us about the silver that's heading over there. I don't believe it at all. But when you talk about exacerbating what's happening, we've already seen almost 17 million ounces of silver delivered into COMEX in the month of October. And when you see a London spot silver price at a $3 premium to the New York futures, a spread that hasn't been seen maybe ever, at least since the Hunt brothers in 1980, and borrowing cost in London that has spiked to 100% annualized, worse than the 1980 panic. What this tells us is that the demand for physical silver at the highest level. We've talked about the central banks buying it. We've talked about China buying it and flying around the world and buying doré and concentrate. We've talked about Russia and their really massive acquisition of silver over the last 5, 6 years. We've talked a lot about Saudi Arabia and their fund, who just bought a few $100 million worth of SLV. And that sucks in and of itself that it was SLV. But remember, at the level they paid or bought, they can stand for delivery. We've talked about Russia adding it to their strategic stockpile. And lo and behold, we find the United States, the U.S. government, who wouldn't know a silver coin if it fell on their foot, it seemed all of these years, have now reclassified silver as a critical mineral. They have put a floor under the price of silver. So when you put all of this together and then add into it the most sophisticated traders on Wall Street, bringing metal in at the levels that they are, that is what is driving this. And in an environment where the LBMA, according to David Jensen, someone that you need to get on our show, David Jensen is amazing. And no one talks about the LBMA backdrop the way David does. And I think it's really very important we get him on. But what he's been saying lately is that there's a 140 million ounce float of silver in London, meaning that's the amount of silver backing the contracts. The other silver they have there, the other 500 million or so ounces, belong to the ETFs. So the only metal that is available, supposedly unencumbered, and who knows how much of it is unencumbered, when they already told us last year that they overstated those numbers by 100 million ounces at the LBMA. But if we take them at their face value, 140 million ounces, according to David Jensen, trading 600 million ounces a day in deliverable contracts. What could possibly go wrong? We have an environment where the exchanges and the paper promises are being usurped and passed on, even at large premiums right now, where if you sent your metal, if you bought a contract on futures and sent it to London at a $3 spread, that's a big arbitrage. And there will be some players that do that. But I don't think the smart money, even at a $3 per ounce premium to send it to London, really wants to do that, because silver is becoming far more valuable than the currency that is used to buy it or to sell it.
Andy feels the high-profile tales about metal being airshipped to London are part of a PR campaign to reassure markets. If exchanges and custodians show movement and replenishment, lenders and counterparties are less likely to call margin destabilizingly. Markets require calming for more than appearances. It's physical availability math. Short holders' mechanical ability to meet delivery obligations decreases as paper contract inventories shrink relative to deliverable claims. Backwardation, rising borrowing costs, and concentrated deliveries take metal off the exchange's daily float. All of those tighten the physical chain and boost the effective scarcity premium for immediate metal. Simply put, if London and New York cannot prove deliverable metal exists in promised proportions, the market confronts a confidence event. Paper contracts become litigated liabilities and price discovery returns to actual metal holders. The real question is how long they can keep the dam from bursting. Andy estimates it's short. We now consider foreign issues. Andy emphasizes China and other significant purchasers have quietly disintermediated traditional doré and concentrates sourcing routes and increasing vault capacity globally, a systematic accumulation technique that increases Western paper market stress and real-world inventory in precisely selected countries.
Believe it. I mean, I think some of it is, yes. I think that there is some metal that is moving that way. But I think that that's more a PR campaign. I think that, yes, there's always going to be some commercial bank arbitrage that we're seeing right now, where they're able to, by sending it to London, capitalize on that spread. But I don't think that's really what is happening, to be honest with you. I think that is a PR campaign by Reuters and by Bloomberg to kind of say, hey, everything is okay. That metal, look, there is not a chance in hell that the metal can move over there fast enough to meet these demands. You're going to see lots of margin calls and unwinding of positions. And I think that it's just like they told us that silver was coming back here because of tariffs and arbitrage. I don't believe it. I think there is something much bigger at play here. And when the U.S. government reclassifies silver as a critical mineral, they're not going to be in a rush to send it over there to capitalize on some arbitrage. Yeah, you're talking millions of dollars. So what? I mean, I don't mean to say it in a cavalier manner that way, but I think the big noise about sending silver to London isn't strength. It's a cover story to calm nerves. And if supply were just fine, they wouldn't need this PR push. This is a Band-Aid. This is not a cure. Moving a few shipments around buys time, but it doesn't solve the core problem. And that is that there's not enough silver in the right place at the right time. These shipments are not proof at all of silver strength. They're proof of silver stress, in my opinion. And the louder the headlines, the tighter the market really is. And we saw that, Michelle, with all the nonsense that was coming out of the mainstream, like Reuters and like Bloomberg, when all the stuff was coming in. They were saying, oh, it's arbitrage. BS it is. Oh, it's tariffs. BS it is. There's something bigger at play here. And you know what it is? In my mind, this is, for 40 years, the United States bet on a strategy. They bet on a strategy of a strong dollar, U.S. bonds, service jobs, while ignoring factories and commodities and gold and silver, while China did the opposite. It built factories, it stockpiled commodities like gold and silver, and it stayed away from relying on the dollar. And what you are seeing right now, in my opinion, is confidence in the U.S. dollar, really more than anything, disappearing. It's kind of like we call our dollar currency, but it's more like a piece of ice sitting out here on patio here in Aruba. It doesn't last long. It's melting. The value of the dollar is melting, and I think all of these things put together signal to me that this is far deeper than what the headlines want us to believe, especially on places like Bloomberg and Reuters. This is anymore at these levels. You know, the United States certainly is a very, very powerful, great country, but many of the nations whom are rallying against us using commodities as a sidestep to the dollar and the treasury market hegemony, they have a say in all this too. And to your point, the Shanghai Metals Exchange, as you and I have talked about on many occasions, is not only trying to gain credibility and have other countries store their metal with them. Remember, they're in the process of building multi-jurisdictional vaults all around the world, starting first in Hong Kong, now in Saudi Arabia, and then ultimately through the Belt Road. Now, China, the second largest producer of silver in the world, David Morgan will tell you when he went to China, they tried to tell him they were number one. So number one or number two, number one in gold, yet they're flying all around the country, buying all around the world, Latin America, Peru, and Mexico primarily, buying doré, which are crudely refined bars, and concentrate, the byproduct of the mining process, directly from these players, disintermediating the market, right from the miners, disintermediating the market, and sending it all the way back to China on their expense, paying double what the West will to refine it themselves. These metals are becoming very critical to them. So yeah, why wouldn't they want this to happen, to allow the price to go much higher? And how do they do that? The same way I've been saying this since the first interview you and I did together years ago. They're draining the exchanges slowly and methodically. They're standing for delivery in London. The London Metals Exchange has the lowest amount of silver, the float, they've ever had in the 140-year history of the exchange, at least since they started keeping records. And so they have been using the idiocy of the Western suppression system to beat us at our own game. The part that most analysts and most naysayers have a hard time justifying when we say this is that they haven't done it like that. Everyone in this country expects instant gratification, and if it's not fast enough, if it's not immediate, it ain't fast enough. That's their genius. Slowly enough to not rattle the bushes. But they've done a yeoman's job at that. Look at the countries involved: Saudi Arabia, Russia, China, India, they're all accumulating silver in their own way as fast as they can, but also gold, not too fast. And many of the other nations are too. So, yes, this would indeed, and the mistake that we make in this country is thinking that we are omnipotent and we have the ability to control everything. And you know what? As I've said with you before, these countries are now sophisticated, coordinated, motivated, and they have a plan that is methodical, a plan that drives the analysts in the West nuts because it's not in your face bang. No, but take a step back. It's just like the title of my show. Little by little by little by little by little, and then bang, all at once. And we haven't seen the all at once moment, but is this the beginning of it? Maybe, could be, don't know. But absolutely, to your point, this would benefit not just China, but all of the BRICS nations. To say they have a hand in all of this and to poo poo it and say no way is as naive as a mud wall. It's absolutely, I think, very plausible that the Chinese have not only interest in seeing this, but are understanding that their actions and slowly exacerbating it ultimately is to their best interest. Yeah, by standing for delivery all around the world. And that's what they've been doing. I believe that they have been involved in shorting the paper price as well, because if you can't beat them, join them. And then going all around the globe in places like London, in places like Shanghai, all around the globe, including the miners directly disintermediating the marketplace and pulling silver inexpensively at a subsidized price because of the futures leverage, because of the suppression, and buying as much as they can, anything that's not nailed down all around the globe from centers that do not trigger price discovery. It's the Elbia, it's the COMEX that triggers price discovery. And so they're using the suppression of the Western paper market and probably adding on to it in an effort to do exactly what we're talking about. Slowly, instead of suppressing the market for other gains, political or militarily or whatever it may be, dollar supremacy, bond market supremacy, pick your poison. They're doing it because they realize we are entering a period of time where commodities will define the strength and legitimacy of a nation. And those commodities are not just going to be gold and silver and platinum. Platinum's another example where the head of the TOCOM, Bruce Ikamoto, or I'm butchering his last name, but Bruce, the head of the Japanese TOCOM, says they're trading over 3 million ounces of platinum a day in London, but in, as he says, loco, meaning location, London and Switzerland, 0 ounces available. What could possibly go wrong if you're trading 3 million ounces of deliverable spot contracts a day against nothing? And the same thing is true in London. What could possibly go wrong when you have 140 million ounces with 2 billion ounces in contracts out there that could stand for delivery, not to mention the 600 million you're trading per day? What could go wrong? The Chinese have slowly played this game.
Most investors should psychologically separate paper liquidity from physical liquidity after Andy's comments. The former may appear large on a spreadsheet, whereas the latter is concentrated, burdened, or unavailable for transfer. Paper contracts promise and depend on counterparty performance. Logistics, custody, and owner willingness to part with physical metal are essential. When sovereigns, delivery ETFs, or strategic stockpiles store a considerable portion of accessible metal, paper substitution margins of safety erode swiftly. Second, backwardation is more than a price anomaly. Actionable indicator indicating immediate demand exceeds future supply projections. A continuous spot premium shows that traders and allocators may benefit from physical allocated metal delivery certainty and counterparty failure insurance. This is especially important if institutional players are buying to stand for delivery, as Andy notes. These decisions compound with each delivery cycle and reduce paper market float. The geopolitical aspect of commodity ownership changes when China, Russia, Saudi Arabia, and other significant buyers quietly accumulate across states, as Andy describes. Nations prefer local stockpile and controlled allocation over short-term arbitrage when a commodity is strategically vital. That conduct can separate local spot markets from global paper indications and generate regionalized scarcity, raising prices and volatility. Thus, Investors must assess custodial location and vehicle exposure. Tightly titled bullion behaves differently from ETF shares and futures contracts. Finally, tactical or strategic reallocation investors should use a graded, evidence-based approach. Check the custody agreements behind your exposure. If possible, quantify the deliverable float versus existing claims and increase allocation to physical possession ownership. Avoid treating silver as a speculative tape reading trade to hedge systemic counterparty risk. Consider it portfolio insurance whose value is rising because trust architecture, paper versus physical, is being questioned. If this analysis helped, like and subscribe. Investors who want to look beyond headlines and grasp fundamental mechanisms that drive returns and dangers can use our evidence-based breakdowns. Thanks for watching.